Hey everyone, this is Jim at SP500chart.com. It's a little after 5 o'clock on March 12th, 2013. We're going to take a look at the S&P 500 chart. And I want to remind you, well not remind you, I want to tell you that I'm going to be posting another video that I will just link to. And it's not a subscription video, but it's on gold using GLD as a proxy for gold. So I'll look for that. One way you can look for it is to subscribe to the YouTube channel Old School Chartist, and that's where everything is eventually released to the public that I do for the subscription site. But got a video on gold. I think it's kind of interesting. I'm long gold, but with a fairly tight stop. So anyway, that said, before we take a look at the chart, I need to remind you that the website and the video are for educational purposes only. Nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional, but I am just a guy who draws lines on charts. Okay. Today we get maybe a little sign of a little weakness, and nothing technically significant, because up here, to be really technically significant, it needs to be about a 15 and a half point move. And that's one of the things that's making this a little touch and go. When you're dealing in markets that are routinely making 15-20% swings, and you are able to apply that 1% rule, then you're really set up pretty sweet, because you're expecting a 1% or better break of a certain line, and if you get that, you know you got another 18-19% to go. Once that clues you into the direction. But now we're dealing in this compressed area where everything is getting smaller and tighter and squeezed, and I don't mean as in a short squeeze either. It's just getting squeezed in terms of where the market, how much leeway the market has to give us, how much wiggle room between the tops and the bottoms. When that gets to be where it's just 3 to 4%, then all of a sudden now you're dealing with a situation where a 1% confirmation of a broken trend line or a broken pattern boundary, all of a sudden now that's half the game right there. And so that makes it a little difficult, because you want to look at this little channel right here, for example, and you want to see that and kind of visualize it the way you've been seeing things work a year ago. Does that making sense? So in other words, what I'm saying is this. If we were looking at the chart let's say 2 years ago, and ignore the fact that this is just a 15-minute chart, we might see this in an hourly chart, and this break right here, instead of being about a 3-point break at its greatest distance underneath this line, it might have been a 15-point break. And that might have been taking place in a market when the S&P was around 1200. So all of a sudden, that would be a technically significant break. And if the scale of things was different, it could be. But right now we're dealing on a small scale. So those little those rules about the 1% thing, I think they still work, because still 1%. What's a good? I'm at a loss for words, but I think you know what I'm saying. That this chart, if it had been an hourly chart 2 years ago, what we saw happen today might be technically significant. But since we're looking at a 15-minute chart and in a market where the moves are smaller and smaller and getting more squeezed and more squeezed down, I just, this may just be a little anomaly. But let's pretend like this is something of technical significance. If it is, well, then we would expect this blue line, now that it's broken, and it's, like I said, it's a short-lived line, but now that it's broken, we would expect this line to offer some resistance. And if it does, then I'm still thinking our 1565 target is very reasonable. And the reason I say that is, even though we're under this line, if we never get over this line again as long as the market lives, we still got room to hit 1565 in a day and 2/3. Now there is a little resistance line up here which could also come into play, in which case we could hit the 1565 target in 2.5 days. So this doesn't really interfere with the target prediction from this inverted head and shoulders pattern. And if the S&P were to sell down to 1528 and then show signs of firming up there, that might be a tradable event, because that would still leave the 1565 target unmet, and I would still expect it to get met. And I do, purely based upon the odds of how inverted head and shoulders patterns tend to play out, with roughly 75 to 80% of them meeting their targets. Now let's back out just for a second, and I'm going to show you some inverted head and shoulders patterns, and we're going to see which of them have failed to meet their targets. We had one that was 9 months long that culminated with the inverted head being the market low of March 9, 2009. That pattern met its target. We had a smaller inverted head and shoulders right here after the flash crash. That was right about when I started doing my YouTube channel. That inverted head and shoulders met its target. We had kind of an ugly pattern that took place in the fall of 2011, eventually made an inverted head and shoulders. It met its target. We had a small inverted head and shoulders right here. It met its target. We had a small, let's go to a daily chart now. We had kind of a head and shoulders pattern right here. And this one was a little funky looking too. This was right when we started seeing these short right shoulders on the inverted patterns, as well as even on a top that took place here. But then we had another little, too far out. We had another little inverted head and shoulders pattern right here that again had a little short shoulder on it, but it made its target. And now we've got another one. I just have a tendency to think that the way the market has a pretty strong batting average over the past 4 years on these things panning out, I think I'm going to stick with it. So as someone might say, that's my story and I'm sticking to it. So like I said, little signs of weakness today with the breaking of this line, but there's still adequate, there's still a number of pathways to get up to that 1565. It could be just to kind of follow this general a path on up. It could be to sell back a bit and then have a back test rally again on this red line. So you hear what I'm saying. If we ascribe to all of the trend lines on this chart, if we pretend that every single line on this chart that is supposed to be resistance works as resistance, then all that means is it's going to be maybe 6 days before 1565 gets hit. But if we think that this line is still maybe gonna act as a little support, because you see we closed just almost on it, then, and again, here's this little blue line right here. Maybe we stay above this and below this, and we make that target in about 2.5 days. All I'm saying is, and I know I'm talking your ear off. All I'm saying is we still have the inverted head and shoulders pattern. We still have the target. I say go with it. The target will get hit. That's about 1565. Once we get there, if it happens on a back test, then you look for signs of reversal to come back down. So look, guys, that's the video for March 12th, 2013. I want to remind you again, look for the video I did on GLD. It's an interesting chart. There are 3 technical reasons to believe, by looking at the GLD chart as a proxy for gold, there are 3 technical reasons to believe that gold is ready to head back up. That's all I'll say. You got to see the video. I'll put a link to it for subscribers. If you're not a subscriber and you're seeing this video on the weekend after it was produced, this is a Tuesday, so you'd be seeing this on the following Saturday, then just go to my YouTube channel and find the gold technical analysis chart. Find the one that was done on March 12th, 2013. Thanks again for watching, everyone. Take care.